All right, part two, picking up where we left off. But first, my disclaimer again. Read it. I'm not responsible if you gain or lose money. Not a broker, not a financial advisor. You're on your own. Okay? All right. All right, so picking up where we left off, we spoke about the ES and VX futures and how we use them to help us identify a market trend. Now, when the market opens, right, one of these are going to be up and one's going to be down. Okay, they run counter to each other. And so what your job is, right, is to quickly identify where the market is probably going to head in the next, I don't know, 5 minutes, next 4 minutes, next hour, right? You want to have a sense of whether we're bullish or bearish, whether we are moving sideways or we're consolidating. And we use the VX and the ES futures to help us determine that. Now, in these two charts, we can see that the ES is actually on an uptrend from the open. Okay? And the VX is on a downtrend from the open. So what this is telling us is that our stocks should be climbing higher because the ES is actually on the uptrend and the VX is on the downtrend. Now, if the VX was the one on the uptrend and the ES on the downtrend, then it would mean that our stocks are actually heading lower, right? And this is actually a good example because here you can see that the ES is actually down, right? And the VX is actually up. Now, even though the ES opened in red, we did have this big up move. So because the ES opens in the red, it doesn't mean that the stocks are going to fall at the open, right? And because if it opens in the green, it doesn't mean that the stocks are just going to completely run to the upside. You have to expect the unexpected. And that's why you need plans for both a bearish and bullish trade. Right? Yeah. Now these yellow lines that you're looking at, these are my support and resistance lines. And we use them to help us determine the levels which we're either going to run through or deflect that. All right, and we'll talk about that in a little later. We also spoke about the strike prices. Now this is an option chain. Okay, this is where you select your options. Your strike price is here. These are your strike prices in the middle. Okay. These are your options, your call options on the left, and your put options on the right. Now we buy calls if we expect the stock to move up in price, and we buy puts if we expect the stock to move down in price. Okay? Both calls and puts have a quote. Each option has a quote, which includes a bid and an ask, right? Bid and an ask. Now, the bid is where you sell at, okay? The ask is where you buy it. So when you're entering into a call or put option, you enter by clicking on the ask. So if we come down here, any one of these numbers here, this would be the cost for us to enter the trade per contract. Now, because with options, when you buy an option, you are in control of 100 shares. Whatever the price is here, you have to multiply by 100 to get the cost of the option contract. So for instance, the 167.5 at the money call option here would cost us $147 per contract. Now, at this very moment in time, if we were to get into these call options, it would cost us $147 to get in. If we were to sell it right after, we could only sell it for $139. So you can see that if we hopped in and hopped out, we'd actually lose money. The difference between the bid and the ask is called the spread. So whatever strike you enter at, the difference between the bid and the ask is what you automatically lose. Okay? There will never be a time when you buy a stock or a option or a future or whatever other financial instrument. There'll never be a time where you get in and you're automatically up. It doesn't work like that. The bid-ask spread is how the market makers make their money, right? So the difference belongs to them. That being said, you want to trade stocks that are very liquid, that are trading high volume. Look at this example. We have Facebook, and at this point in time, whenever I took the screenshot, 31 million shares of Facebook have been traded up until whatever point this is for that day. That's a lot of shares. So you're talking about 31 million times about 167. That's a lot of money flowing into and out of the Facebook stock. And so the more volume that's traded on the stock actually benefits the option prices because they make the spread tighter, right? And these are the type of options you want to play. Okay? If you go to a stock or you choose a stock that is not very liquid, is not trading high volume, what you'll have is wider spreads in your bid and ask, right? So where if you trade Facebook, you might be down automatically 2%. In an illiquid stock, you might be down 20% from the jump. You do not want that, because that means that you will have to ultimately try to recover that 20% deficit and then make a profit. Okay? So you want liquid stocks, you want liquid options to trade. We also see over here we have the open interest and volume. You want these numbers to be high because they also help tighten the spreads on these options. Implied volatility is very important. The lower the better. If you trade options with very high implied volatility, if the implied volatility drops for whatever reason, so will the value of your options, right? If they increase for whatever reason, so will the value of your options. But we normally don't see big jumps in implied volatility until around earnings seasons, or unless there's just been a massive amount of trading volume within the stock. Now the blue shaded area, these are actually the options that are already in the money. And what that means is that the strike prices have already been hit. So you can see that the current stock price is at $167.18. 165 has already been passed, which puts this option contract in the money. The next strike price to be hit is these 167.50s, right? Which is at the money. The rest of these are out of the money. Okay? You want to stay either at the money or one out of the money, right? It can be very tempting to play these much cheaper stocks. I mean, not stocks, options. Because if they get hit, then the percentage gain is ridiculously high, right? So you can gain a lot more. But in all reality, most of these stocks, they only on average move about 2 or 3% on a good day. All right. You can see here percentage change. The stock was actually down, right? And so because the stock was down this day, the puts are what gained in value. Isn't that nice? 116% gain on your investment. Now, if you're in a call, then you'd have lost this much. I mean, whatever strike you were in. So, yeah, choosing a strike is very important. And also, theta, which is time decay, will quickly eat at your option values the further out of the money you get, more than closer to the money or in the money. Theta is always at work. Always at work. The only way to slow it down is to purchase contracts that are further out, that expire much further out. Right? Theta won't affect them as much, but theta is always at work. Yeah, I pretty much just went over this, but let's take a look. Time decay, theta, always at work. More effective as options edge toward expiration. Implied volatility affects option premium as it increases and decreases, resulting in overpriced or underpriced contract cost. Implied volatility crush decimates options values, especially around earnings. Option liquidity. Liquid options follow liquid stocks, allowing for tight bid and ask spreads. You want to choose options that have high open interest and options volume. See, high open interest and options volume. Have to make sure you choose the right strike. Now, indicators. Indicators are used in technical analysis to determine trend and trend reversals. Can be used to develop a systematic approach to entries. Best to use only a few. All right. Let's look at the chart. Okay. So these are very bullish charts, okay? When we're bullish, we want to buy calls. Now, the main indicators that I use the EMA lines, the exponential moving averages, the 9 and the 13, and I use the parabolic stop and reverse, or parabolic SAR. All right. Also, volume is one of the most dependent upon indicators. Let's see. The EMAs act as support or resistance. Okay. The EMA and the parabolic SAR act as support and resistance. Whenever the price action is above both the EMA lines and the parabolic SAR, it indicates an uptrend. Okay. Same as it does here. Indicates an uptrend. right? When the trend changes, you will have the price action falling below or crossing over from top to bottom of the EMA line, and the EMA will act as resistance. The SAR will actually flip to above the price action as the stock moves downward. So support and resistance, very, very important. Support is the area where the price stops falling and where demand is thought to exist, typically where bulls enter. Support assume possible trend reversals or continued uptrends. Okay, support is where the smart people enter. Okay, they identify it based on their indicators or price action or whatever they use to make that decision, and they enter early at or near support. Okay, let's get back to our charts. On a bullish day, right? Bullish days clearly means that the stock is going to go up, right? Where people are getting into their stock is at a support area. Okay, where they get in here, this is where they buy, and as the stock is making its move to the upside, they're selling to people coming in on the move. Okay, they've gotten in front of the momentum, right? So they capture most of the premium in the stock move, right? This is where you want to be when you enter a bullish trade. You want to be in or near support, right? You capture most of the move, and if by chance the stock begins to reverse, you should still be able to exit with at least a small profit, or be able to cover before any resulting loss to your capital, right? You want to be early on trades to capture most of the profit and to salvage most of your investment. That's why we're getting that support. A lot of visuals on support and resistance will tell you to get in after the stock has broken past a certain point, which can work, right? But why not be early? Why not capture as much as you can, right? Now, resistance is the area where the price stops rising and where an abundance of supply is thought to exist, typically where bears enter. Strong resistance assume possible trend reversals or continued downtrends. Let's look at some resistance areas. So, resistance areas is a point where the stock stops moving upward, right? This is a pretty good example on this Amazon here, because we opened up, we fell, caught some support, had a bounce, and we could not get past this level here. Just could not get past it, right? And so what happened was we sold off. No, your ideal entry point was in this area here, right? And you want to get as close to the top of resistance as possible if you can, right? And many times what happens in a bearish environment, you'll get a sell-off or a stall like you did here. Had this stall here and we just completely sold off. Or we get a quick dip, then a small pop like we did on Amazon. Cannot get past this first opening high here and we just sold off. Or we have times where we get a big dip at the open, like this big red candle here, and the stock starts to close this gap, gets to the EMA line, and then gets completely rejected. It keeps moving down. These patterns are very common and easy to play, but you can tell a bearish stock by the price action moving below the EMAs and the parabolic SAR. Now, one thing to note about support and resistance is that once support is broken, it then becomes resistance, like it does here. Support gets broken and then becomes resistance. Okay, let's look at an example actually. Now I like to plot my support and resistance on my on a 15-minute chart when I'm plotting on the ES or VX, right? And I like to use the day before, the previous day, and whatever happens in the overnight session, right? So let's look at what's happening here. So on this day we had some resistance here, 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 here. The overnight session we had some here. Now we've plotted from the previous day and the overnight session. Okay, so overnight we came down, broke this support area, right? Came down and found support here, came up back through this resistance area, could not really break this resistance area, so we came back down, came back toward it just a little bit, could not make a move up, came back down to this area of support, bounced, could not get past the resistance area here, came back down, broke support, broke support, found some support here, strong support areas, because you can see how many times the price action is actually bouncing off of this level. So that'd be strong support. Finally started to make a move up right into this resistance area here, could not break it, came down, right, found some support, came up, broke through just a little bit, and what happened? Since we came into the open at a resistance level, we had a hard rejection and we began to move downward, right? Broke the support area here, broke support here, came all the way down here. Now if you look at the candlesticks, whenever you see a long upper wick, right, it means that the price is being pushed down. There's a lot of selling pushing the price down on this candle. Over here where you see the long bottom wick, there's a lot of buy action pushing the price up, right? On this candle we actually opened up lower sold off, and then got bought back up, right? These wicks are good indications of strong support or resistance. Okay, so back to it. We came down here, found some support, made a little bit of a move up into this resistance level here, couldn't break it, came back down into the support area, and then made a strong move past this resistance area up through this resistance area. Had a little sell-off. Now remember that once we break resistance, it then becomes support. So we broke here, we sold off back down to this level here and found support here. Broke through this resistance level, got rejected here, and sold off right around this new support area where we bounced from and then sold off. Support and resistance is something you'll have to practice in plotting. I like to plot it on my 15 minutes on the ES and VX, and in the individual stocks I like plotting the support and resistance lines on the daily charts. Okay, and I'd go from here, the top of the body, to the lower end of the body, and also the top of the wick, the lower end of the wick. Right now, these are levels that are pretty much respected in the minds of a lot of traders, where if the stock comes into support, they'll buy. If it comes into resistance, they'll sell. Right now, how strong or weak that support or resistance level is completely dependent on market conditions. If we have a strong market, then we're going to break through these resistance levels. If we have a very weak market, then we're going to break through these support levels. Sometimes you have a lot of buying pressure or selling pressure that completely takes out these support and resistance levels out. And there's money to be made in that too. So now the takeaway from this is that whenever you have a bullish market and you have your stock climbing up, all right, in value, all you need to do is find a place to get in. Okay, you find a place to get into the move, and you capture whatever profit you can capture from that move. All right, in the bullish environments, you want to get in as close to support as possible. All right, and what will happen is you'll have a big uptick like here, and you have a small pullback. Once you see that pullback getting some good support, some good buying support, which usually investors look for that at the support lines or the EMA lines for that support, and you get confirmation that, okay, our stock is making higher lows, that's your confirmation to get in. Right? If you're in a bearish environment, again, you're looking for a place to get in with as little risk as possible. Okay. Now, if you look at this example here, if you see we have an area of resistance here that we cannot, break through, and the stock start to come down, right? If you enter in this area here and you somehow get caught up in this bounce, it could shake you out, right? And you will jump out of the trade with a deficit when you really should have just held it through and captured all of this move here, right? And this is why you need to get in at resistance as close to it as possible, so you can sit through these little bounces that will take out the value of your option contract.